Have you ever wondered how companies make losses disappear or magically boost their profits overnight? It is called creative accounting. This is not always illegal, right? But it can be very misleading. Today, we are breaking down how some companies, including some big names, how they have used accounting tricks to actually inflate their performance, and how you can actually spot this as an investor, because it actually can be misleading and you have to be very, very careful on which company or which business to actually invest in. All right, so first and foremost, we'll be looking at the concept of creative accounting. What is creative accounting? So basically, creative accounting is simply when a company tries to bend accounting rules to make their finances look better. So when you think of creative accounting, simply just look at you trying to put a filter on your picture. When you put a filter on your picture, what you're trying to achieve is basically trying to make your image look better than it is actually, and that's the essence of filter. And so when you talk of creative accounting, it is not different from trying to just put filter on your financials, and the reason is simply to make the image of your company look better than it should actually. So what are the tricks? How do these companies actually do this? The first trick they use is revenue recognition criteria. When they try to recognize revenue earlier than the revenue is actually made. We've had instances where a big company used this to recognize billions of revenue. The implication of this was the share price of that company actually went up drastically, but when the truth came out, the share price fell, and then a lot of investors actually lost their money. All right, so that's the first method, revenue recognition criteria. The second method actually is debt financing, kept off balance sheet. All right, so when you have a lot of liabilities, debt, and you don't put to know, you keep it off balance sheet. When you maintain a lot of debt off balance sheet, what it simply means is that you're hiding your liability. All right, so when investors assess your financials, they make it look like, oh, you are actually in the net asset position and all of that. Meanwhile, in real sense, you have actually kept a lot of liability, your debt somewhere that you don't want them to know. All right, so how do you spot where a company is actually going, or a company is actually into creative accounting? The first one is actually to compare the revenue, the trend analysis of revenue, and also try to compare that revenue with cash flow. When you see a company's profit significantly increasing in comparison with the cash flow, it's a red flag, and you need to actually check why the revenue is increasing, where there's a surge or a hike in revenue without the corresponding hike in the cash flow. You need to be very, very careful. And also the second and important one is also to ensure that you read expert opinions or professional opinions on financials. Every company, listed company for instance, they are listed. If they are listed, it means that their books are audited every year. If the books are audited, it means that auditors or professionals will have given their opinions on this financial. So if you go to the opinion part of the financial where there's a case of window dressing or creative accounting, the auditors will have probably disclosed that, or you see that indices in their report. And this would actually help you to know whether a company is actually energy company actually did this, I think in 2017, where a lot of debt was actually kept off balance sheet, and eventually when regulators stepped in, a lot of issues came up, and then the share price also dropped drastically. So why creative accounting may actually seem to be like a win situation for every company, it's only but a short term. You should worry as an investor, because if you invest wrongly in a company that has bloated their profit over a year, because when profit is bloated, the implication is that the stock prices are actually high. If it's high, it means that you're buying into bubble. All right, so and when the bubble bursts, what happens is the share prices actually drastically fall, and when this happens, you may end up losing substantial fund or your investment to such tricks. And so it becomes very important for you as an investor, for you as a company, or for you as a finance enthusiast to actually check and review these financials before you go or make your conclusions on viability of any business or how good a company is doing. Let me know in the comment section if you have actually spotted any company that is into creative accounting in the past and how you were able to spot it. Thank you for watching. See you again in the next video. Please like our video, share our video, and subscribe to the channel to get more videos on finance. Thank you once again, and see you in the next video.